You said the Federal Reserve is going to start expanding its balance sheet.
My
Under
guess is that they will have to. Otherwise, they'll lose control over the repo market, and they don't want that to happen.
Joseph, great to see you. Welcome back to Monetary Matters.
Thanks so much for inviting me. It's a pleasure to be here, and congratulations on the success on your show. It's such great guests over the past few months.
Appreciate you saying that. Joseph, obviously, you're writing at fedguy.com. You used to be a senior trader for the New York Federal Reserve, which is where the bulk of the monetary operations go. Just coming out of the Federal Reserve meeting, we had the interest rate cut from 4.1% roughly to 3.8% roughly. A lot of questions about what the Federal Reserve is going to do in December. Is there going to be a cut? The market was pricing a cut. Powell said, not so fast. His exact words were, a cut in December is not a foregone conclusion. Far from it, which for Jay Powell, that's basically saying, like, did I stutter? That's a big bombshell. But Joseph, want to set aside rates for a second. The 20-minute, 30-minute mark, we'll talk more about rates. Want to start out with the balance sheet and money markets, which is your expertise. That's what you were doing at the New York Fed. Powell dropped a big announcement that the Federal Reserve's reduction in its balance sheet, or quantitative tightening, QT, is going to be effectively over on December 1st. So break this down for our audience here today. What's the significance of it, and what's your interpretation of the specific mechanics?
First, I'll talk a little bit about why they're stopping QT, and then I'll talk about the much bigger question, that is what the final composition of the Fed's balance sheet is going to be going forward, because that's the part that's actually going to have a market impact. So the Fed has been shrinking its balance sheet through QT for some time, and when they shrink their balance sheet, what they're doing is they're solely withdrawing liquidity out of the financial system. Now, they want to make sure that their balance sheet is just small enough so that the banking system has enough cash to function. Now, a bank holds deposits at the Fed. They're called reserves. So that's what they're thinking about. Now, the problem is that the Fed doesn't actually know what the right size of right size for their balance sheet is, or another way of saying this is how many reserves the banking system needs. Now, they have models and so forth, but at the end of the day, they don't really know. Now, the last time they did QT, they kept shrinking their balance sheet. And in September of 2019, there was a tremendous spike in the repo market that forced them to intervene. Now, the Fed thinks that one of the reasons why there's that huge spike in the repo market back then was because they overdid QT. So they're very eager to avoid that right now. So when they're looking at whether or not they're shrinking their balance sheet too much, they look at market rates, specifically market rates in short-term funding markets like repo rates and the federal funds rate. Now, over the past few months, what we've seen is that the reverse repo facility balances have gone down slowly and now are basically around zero. So reverse repo facility is basically a place where money market funds park their excess cash, and the Fed looks at it as kind of a repository of excess liquidity in the financial system. So when that facility went to zero, repo rates began to gradually drift higher. And over the past few weeks, they've traded higher than Fed funds and higher than interest on reserves. That sent a strong signal to the Fed that, maybe we should stop doing this QT. And that's what Chair Powell mentioned today. Now, QT has actually been tapered over the past few months, so it's really not a big deal in the market anymore. But they noted today that they're going to stop it effective December. So that's kind of the big thing they did with their balance sheet. Now, from my perspective, when I look at repo rates, and since the Fed likes to focus on this, if you're the Federal Reserve, one of the most important things you can do is you have to control short-term interest rates, because that's how you adjust policy, right? You're trying to toggle short-term interest rates to adjust the financial conditions through the wider market and impact the real economy. So your bread and butter is being able to control short-term interest rates. So repo rates are part of that complex, and it's driven by supply and demand like anything else. Part of the supply of funding available to lend in repo is related to the size of the Fed's balance sheet. That's definitely true there. But the demand, though, that's largely because the United States runs a 2 trillion fiscal deficit, and at the end of the day, some of the people who buy the treasury debt finances those purchases in the repo market. So that's kind of necessary, because let's say that you're issuing $2 trillion in debt. Let's say that the U.S. Treasury, you show up to the market, you sell like 10 billion. Most people don't have that lying, under a couch or in their pocket or something like that. So you need someone who's be able to elastically expand their balance sheet. So buy that on leverage, because if you buy it on leverage, you get the money instantly, right? You don't have to rely on inflows from your investors or premium payments from your insurance people who buy insurance from you. So at the end of the day, a lot of the purchases in the cash treasury market to finance the US Treasury are funded in the repo market. And as you have tremendous issuance, demand for repo increases. So for the Fed right now, they're stopping their balance sheet, thinking that this is going to have an impact on repo rates. But at the end of the day, as long as the fiscal deficit continues to grow, you have increasing demand for repo funding, and so repo rates are going to go higher. So my expectation is that they're going to have to be adding liquidity into the financial system shortly. And they can do this in a couple ways. One thing that's different this time compared to the past is that they have something called a standing repo facility. And what that means is that if you are a securities dealer, you can go and borrow from the Fed, uh, borrow repo from the Fed, basically at any time you want. And they've been doing that, but really not a lot. And also, obviously, not enough to constrain the repo rates. And there are probably technical reasons for that with regard to, okay, super in the weeds. But if you're an SRF, you're borrowing in tri-party repo, and that's not balance sheet friendly. It's not nettable. And so I think that's part of the reason. But what they're likely to do going forward is once they realize that stopping QT does not put downward pressure on repo rates. Once they see repo rates continue to rise, they're probably going to be buying a lot of bills to add liquidity into the financial system. They call these reserve management purchases, and they did that in 2019 as well. So that could happen actually maybe as soon as December. I mean, it's really hard to say about these things because so much of it is opaque. Like the spike in repo markets in September 2019 came kind of out of the blue. I was there at that time. It was kind of exciting. So I expect them to be expanding their balance sheet again shortly. But that's actually pretty technical. The really big picture that's going to impact markets going forward is just what the ultimate composition of the Fed's balance sheet will be. Now, that's kind of important because the way that the Fed impacts market pricing through their balance sheet is through the supply and demand of treasury securities to the private sector. So if the Fed, for example, is going out and buying a bunch of 10-year treasuries, there's less 10-year treasuries available for the private sector, right? Less supply, uh, lower interest rates. Now, right now, the Fed has a portfolio whose duration is pretty high, much higher than the overall markets. That's by design. They bought all these treasury securities because they wanted to put downward pressure on longer dated interest rates. So they swallowed up a whole bunch of duration. On the FOMC right now, and this is something they're still discussing, but from what we've heard, and we've heard from a couple governors right now, is that they're going to be pretty hawkish on the balance sheet. Governor Waller, for example, would like to, maybe just hold a lot more treasury bills, as many treasury bills as they have reserve balances. So that'd be upping it significantly by over a couple trillion. So what does that mean? Well, if you have to hold, let's say, 3 trillion bills, that means you're going to have hold fewer coupons. And that means that the private sector is going to have to hold a lot more duration. So, that's kind of super hawkish in that it will increase the supply of duration to the market. And maybe they'll do that slowly, and really depends on who's on the committee. Another member, Governor Bowman, has actually even suggested that the Fed should outright sell mortgage backed securities. Now, I mean, that's going to be, you know, so if you sell mortgage backed securities, the market's going to have to absorb it. That means higher mortgage rates. And, that could be potentially pretty disruptive. And I think it's going to make a lot of people in the White House unhappy. But listen, I think what I've taken away from this so far is that the people who have been very hawkish on the balance sheet have been the Trump appointees, the same people who have been clamoring for rate cuts over the past few meetings. And so I think that suggests that maybe the Fed is still functioning as a pretty independent organization. I'm just talking about Governor Bowman and Governor Waller because they were the people who have been clamoring for rate cuts in the past recent month, going so far as to dissent. So there's a narrative out there that all these guys, because they're Trump appointees, that they're just going to, cut rates and do what the boss says. But what they're saying with the balance sheet is very hawkish. So I think that it's more complicated than that narrative.
So I'll get back to the balance sheet in a second, but what you're saying is that the President Trump appointees on the Federal Reserve Board are uh, 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 they are not being super dovish and doing whatever the president wants on the balance sheet, counter to the narrative that they are doing whatever the president wants. On the interest rate story, how are you evaluating that narrative?
So I will just add one more thing here. So in 2019, the Fed had a confidential memo that was subsequently declassified to the public. And in that memo, they said that, if we were more hawkish on the balance sheet, longer dated interest rates would go up and we could cut more on the front end. And my sense is that rather than these Trump appointees just trying to please the big man, they are being very political and diplomatic in that they are giving the president the rate cuts he wants, but on the other hand, taking it away by being more hawkish on the balance sheet. So you end up with a steeper curve, but the impact on the economy is about the same. So I think that's actually what's happening at the Fed. So it doesn't seem like the Fed is completely part of the executive just yet. Probably will be in the coming years, and maybe it should be. I don't know, but not yet. Now, on the interest rate part, I think we should kind of level set a little bit. So, the last time we had a Fed meeting, we had the dot plot, and the dot plot guided towards two more cuts this year. So, a rate cut today and a rate cut in December. Now, between then and now, it's been a difficult time because of the government shutdown. The Fed has been basically flying blind, not receiving a lot of the important data that would usually inform their decisions. Now, they do have access to private data like ADP, like Adobe data, and they have their own internal network where they go and they talk to people and they write the beige book about it. Now, between then and now, it seems like inflation has come in a little bit better than expected, but at the end of the day, it's still around 3%. And the labor market still, kind of slow, trudging along, low hiring, low firing, not doing anything there, but not deteriorating. And heading into today, the market was fully pricing in one cut today and one cut in December. But Powell surprised the market by just openly pushing back against that. I think his memorable words were not a foregone conclusion, forcefully suggesting that maybe he's not going to cut rates in December. I think the rationale for that seems to be that the labor market is not deteriorating as much. And if you look at these GDP nowcasts, it looks like growth is okay. So that leads us to, and you know, not fully pricing in a December cut, maybe it won't be there. And that I think that's where we are on rates right now.
So going into today, there was fully priced, as you said, that there would be a cut in December. That cut has been taken away a good chunk of those odds. So the interest rate market has changed. Interestingly, when Powell said that it's not a foregone conclusion about December, the market stock S&P was down around 76 basis points, regained a lot of that. So it just goes to show we are not in 2022 anymore, and the days of Jay Powell's hawkishness causing the stock market to decline 2, 3, 4% in a day, and a large bear market in 2022 we are not in that day. We are not; those days are over. At least so far. Joseph, want to get back to the balance sheet. Your first comment. So the Federal Reserve has been withdrawing liquidity since the middle of 2022, just $8.9 trillion to around $6.5 trillion. So 2.2, $2.3 trillion of liquidity removal, balance sheet reduction, and it's been a long and slow and somewhat steady process. That process is going to go on for 30 to 32 more days, but it is going to end on December 1st, and the treasuries are going to just constantly be reinvested, so held steady. The mortgage-backed securities that the Federal Reserve owns are going, as they mature, they are going to be reinvested into treasury bills. So the aggregate balance sheets, the Federal Reserve's assets are going to stay flat, but the composition is going to change, and mortgage-backed securities are going to basically be converted as they mature into treasury bills. That itself is kind of a form of tightening, right? Because mortgage-backed securities have more duration and convexity risk, and just replacing, Treasury bill has almost no risk at all. So you're supplying the private sector with an increased mortgage-backed security. So it is still somewhat a form of tightening, right?
Well, I would point out that mortgage-backed securities that the Fed holds have very low coupons, so they're not going to prepay quickly. So mortgage-backed securities get paid down either monthly as principal payments go through, and that takes 30 years, or if someone refinances their mortgage, that is to say, takes out a new loan to repay the old loan. Now, because the Fed bought these mortgages during the very low interest rates of the pandemic, these are like 2.5%, 3% mortgages, and no one's going to take out a new mortgage to repay that.
Mhm.
So the monthly principal payments that the Fed is receiving each month, it's really low. It's like say 14, 15 billion a month. So I don't think it's going to have a big impact. But when it comes to the mortgage portfolio, though, the Fed would like to have no mortgages on its balance sheet. It wants to have a final portfolio that's old treasuries. The rationale for that is that they feel that owning mortgages is basically the Fed allocating credit to the private sector, and they don't want to do that, even though they've been doing that for quite some time, and to an enormous size too, right? They have a couple trillion on their balance sheet. So if they wanted to go to an old treasury portfolio, they'd probably have to wait 30 years. Now that's a long time. You don't really set goals and just take 30 years to achieve them. So there is a possibility that they could try to speed that up a little bit by selling mortgages. I think that's really unlikely. It'd be a very hawkish outcome. We haven't seen them do that before. Uh, Looking across the world, the Bank of England has shrink their balance sheet by selling outright, but usually people just let them roll off. So that is a possibility. So I think that is one of the interesting things that happened today. Mortgage principal is going to be reinvested in not just treasuries but treasury bills, and Powell noted that's part of the effort to reduce the duration of their overall portfolio. But again, it's going to be so slow and so minor, it's not going to be meaningful. I don't think it'll affect the market.
And now let's connect the balance sheet to repo. As you said, the Federal Reserve's reverse repo facility, which are liabilities of the Federal Reserve, has been shrinking down and are now effectively at zero. So the excess cash parked at the Federal Reserve has been deployed into the financial system as the Treasury has increased a lot of Treasury bills that have been bought by the money market funds that were buying the that we're investing in the repo facility. And so now they are lending to hedge funds who are now buying the treasuries on credit, 10, 50, 100 times levered. I've heard 200, 300, 400 times levered, in the so-called basis trade. So Joseph, painting with a very broad brush, the U.S. deficit and U.S. increased treasury issuance from 2000 to 2010 was funded a lot by foreigners, I mean, a lot of which was China. Let's say 2010 to 2022 was financed by the Federal Reserve in some way.
Yeah.
Yeah, a ton. But also domestic banks, domestic households, domestic corporates. A lot of the financing of the Treasury, and you've been pointing this out on FedGuide.com, has been now from the hedge fund. So it's levered like a bank buying Treasuries, but they're borrowing in the repo market and they're borrowing from money market funds. And as a result, the demand for borrowing, as you say, is insatiable.
Mm.
So the repo rates are spiking and ever so slightly. So, as Powell noted today, over the past 3 weeks, there have been elevated signs of, I'll call it stress, where SOFR rates are 10, maybe 20 basis points above the Federal Reserve rates. And, I'll go both for the New York Fed as well as your website to get the exact data. But even the effective federal funds rate, which is supposed to be the most vanilla rate in the world, is like 3 to 5 basis points above where it should. So stress is in the money markets. Tie this all together, explain this to me as well as to the audience, because I really need your expertise here. And then also explain, on your most recent piece on FedGuide.com, balance sheet dominance. You talk about how the Federal Reserve is losing control of its balance sheet policy to the growing fiscal deficit. Explain that as well.
Well, Jack, you actually had a really good description now on what's happening. U.S. Treasury issuing a lot of debt. The marginal buyer of that debt finances in repo. At the moment, it's these guys who are financing it, buying cash treasuries, selling treasury futures in their basis trade. And so, as long as the US, as in this current configuration, as long as the fiscal deficit grows, there's going to be more demand for repo financing. Okay, demand continues to grow. What about the supply of funds? Well, we exhausted all the money market funds, and right now the marginal lenders are the commercial banks. And because repo rates are trading above interest on reserves, you have some commercial banks that are happily taking money that they have on deposit at the Fed and lending it in repo instead. But the amount of cash they have is not unlimited. So eventually, they're going to run out of cash too, and so repo rates will continue to go higher and maybe spike. If you're the Fed, you have to control short-term interest rates. So that means you're committed to continuing to add liquidity into the financial system to keep these short-term interest rates under control. And that means you lose control of your balance sheet because by pitting rates, you lose control over quantities. That's just how this is set up here. So that seems to be the game we've been in actually the past few years. We didn't see it. So when the Fed first lost control over short-term interest rates in 2019, they added a whole bunch of reserves and buying treasury bills. And then we had 2020 where they just kind of threw in the kitchen sink and increased the amount of liquidity in the financial system by trillions. But we've burned through all that. So we're back to where we are in 2019, where you have to just keep adding, otherwise you'll lose control over short-term interest rates. So that's kind of an interesting, I think, conundrum they have. They really have no way out of it because it is absolutely essential for a central bank to be able to control short-term interest rates.
Yeah, just to underscore that point, like if the Federal Reserve cuts interest rates to zero on its statement, but actual interest rates in the market are still at 4%, then they have no control whatsoever. Like they're basically, that's like if you or me on a podcast said interest rates are 0%. It's what actually happens in the market, and 99.9% of the time, the Federal Reserve has close to perfect control over these short-term interest rates. But you're starting to see a discrepancy where those interest rates are going up. And I have the data from the New York Fed and from you that the SOFR over the OBFR, overnight something, you can explain it, is now 10 to 15 basis points wide. So those repo rates are going up marginally. And interestingly, it's in the middle, smack in the middle of the quarter. It's not like it's June 30th and all the banks are pulling at their repo financing to make it look good for investors and regulators for their quarterly reporting. This is there's no window dressing at all. And these repo rates are going up a lot. Do you think this is what really drove the Federal Reserve to make this decision of boom, December 1, we are stopping quantitative tightening? And also explain the framework. Powell talked about that framework. Maybe it was Roberto Perli's thing. I know this from you. Talk about that framework for reserve scarcity.
Yeah, I think it's from Roberto. Roberto is the Soma manager. So Roberto or his team came up with a really interesting graph. I think it's like a hexagon or octagon or something like that, that has different corners trying to measure out when liquidity in the financial system is scarce. So he'll look at things like how sensitive is the Fed funds rate to changes in reserves, how high are repo rates, let's say are banks holding back their payments throughout the day, trying to conserve liquidity? Uh, is there increased, let's say, intraday overdraft, things like that? So that's kind of the indicators they look at. But it looks like they looked at all those and decided that yes, indeed, repo rates trading far above IOR. That's not good. I don't want September 2019 to reoccur again. So I'm going to stop it in December 1st. So that's the end of the balance sheet QT story for now. Jack, I think we've been through QE and QT before. This is like the entire cycle, right? So we're right back to where we were a few years ago, I guess.
And do you think the Federal Reserve? I think you already said yes. I think you said the Federal Reserve is going to start expanding its balance sheet. Under
My guess is that they will have to, otherwise they will lose control over the repo market, and they don't want that to happen. So I think what they misunderstand is that the repo rates rise not because reserves are scarce, but because you have a tremendous fiscal deficit that's financed in repo, and without paying attention to the demand side of that, you are going to be misled and end up in a situation where repo rates do once again spike like they did in 2019. And hopefully they'll realize that again, because it would be very embarrassing to make the same mistake twice.
And how are they going to expand their balance sheet? Are they going to be themselves buying treasuries,
Yeah, they'll
treasury
buy
bills?
treasury bills. So
Yep.
a lot of people think that the Fed expanding their balance sheet is QE and it's easing, but that's not how the Fed looks at it. So the Fed looks at QE in a specific way that they're taking duration out of the market. So they're buying longer dated treasury securities. So the private sector has less of a supply and longer dated treasury securities, putting downward pressure on interest rates. Now, from this perspective, when the Fed is buying treasury bills, which are short dated, it's neutral. It's not having an impact on the market, even though many people will perceive it as such. So that's probably what they'll begin to do. I suspect they'll have to do it. I think in size too, because if you look at how well, you look at a couple of things. One is you look at the fiscal deficit; it's 2 trillion a year, roughly speaking. The second thing you want to look at is the growth in repo volumes. Now, SOFR volumes grew 800 billion a year, so that's telling you that there's a tremendous demand for leverage repo financing. Where's that cash going to come from? So it looks like you're probably going to have to add, well, expand your balance sheet by a few hundred billion a year to be able to meet all that demand. So it's complicated because once you let's say that you add liquidity in the system, someone lends it, and it ends up into someone else's hands, and maybe it can be lent again. So how these effects actually circulate and net out, it's hard to say, but it's definitely going to be, I think, in a few hundred billion range.
And yeah, you've got this great chart from your most recent article on fedguide.com showing that secured overnight financing volumes, SOFR, has gone up from $1 trillion in 2022 to $3 trillion now. Wow. So a good chunk of the deficit
That's
is
all.
now
Yeah, it's financed.
in the
Uh,
leveraged hedge fund
well,
community.
Well, listen, these guys, they're not just buying cash treasuries for the heck of it, right? It's part of a spread trade or basis trade where they buy cash treasuries and sell treasury futures. So treasury futures are overvalued because a lot of the mutual funds, they want to have exposure to treasuries, but uh, they don't actually want to go and have a repo a, a repo loan and buy cash treasuries. They'd rather just do it in futures. So they buy futures. It's easier for them to manage that. And so that leads to an overvaluation of treasury futures relative to cash treasuries, which creates this trade where hedge fund can go and then sell these expensive treasury futures on one hand and buy cash treasuries on the other hand and see that basis converge.
And Joseph Powell today in the October FOMC press conference said that they plan on holding the assets constant from December 1st, effectively. For, but in terms of the liabilities, bank reserves are going to go down. So the assets of commercial banks, the liability of the Fed, basically the money that the Federal Reserve owes, commercial banks, is going to go down, and that's going to be offset by an increase in other Federal Reserve liabilities, namely cash, which we're all familiar with, the thing that is in wallets. And how do you think that is going to affect liquidity conditions? Because presumably people are not buying treasuries or securities with physical cash. I bet it's almost impossible. And commercial banks are and bank reserves are what add liquidity and what are liquidity basically. So just explain the significance of that comment.
So over time, people go and the Fed, if you have paper currency, that's a liability of the Fed. If you look at it, it says Federal Reserve note. The amount of paper currency outstanding actually grows every year in line with the economy. Strangely speaking, when you actually look at it, a lot of paper currency is actually held abroad outside of the U.S., probably by cartels or people who want to avoid their own monetary system. So that paper currency grows with the economy, roughly speaking. How do you get that paper currency? Well, you go to a bank, right? So let's say you have a deposit at a bank. You ask the bank, say, "Hey, I have $100 on deposit at your bank. Give me $100 in currency." And where does the bank get that currency? Well, a bank gives the Fed $100 in reserve, and the Fed sends over an armored car to the bank with a $100 bill.
And
And
when
so
you say the bank gives the Federal Reserve, what you mean is the bank asks the Fed, destroy this $100 of reserves that I have, destroy it, right?
no, it's just like when we go
Yeah.
to the commercial bank. like we have $100 in our checking account and we take $100 out. Well, that $100 in our checking account, it's evaporated, it's
Yeah,
erased,
yeah.
and I have a so it's the exact same mechanism. And over time, if the Fed keeps its balance sheet constant, because demand for currency gradually increases, over time you'll have fewer reserves and more currency as people just naturally go and ask for more currency with the expansion of the US economy. But again, that's just what he's saying. I continue to believe that he's going to have to add liquidity into the system to control short-term interest rates. But if I'm wrong, that's what will play out. We just slowly have fewer reserves as currency liabilities increase.
And what's your current read of the stress in money markets? Is it a drip drip very very slow thing, or do you think there's a chance that things could get unhinged quite quickly? I remember, just entering the business in 2019, and first started studying and writing about that repo spike. I had, almost no knowledge about it whatsoever, but I remember it kind of came out of nowhere. What do you think is more likely, that you're going to see a spike that's going to cause the Federal Reserve to intervene, or is there going to the Federal Reserve intervention that you are predicting? Do you think? What are you assessing the odds that that is going to be a proactive measure?
So I think one thing that's different today is that we do have a standing repo facility. And so if there really is an emergency need for cash, they can always go to the Fed. So I think that makes huge spikes less likely. But the thing is, the repo market is mostly an overnight market. So in the morning at 7 a.m., it opens. If you are someone who wants to borrow money, you go and you call up your contacts and you ask them for money and they give it to you. And usually you know each other. So it's kind of a handshake deal, set quantities and prices are market prices. But the thing is, the people who lend cash, they don't actually have super great visibility as to how much cash they have available to lend. For example, let's say that you are a money market fund. You know that on certain days your clients withdraw money. Maybe they want to do a big M&A deal. Maybe they have to pay taxes. Maybe you have less cash to lend. And if you're a commercial bank lending in the repo market, again, you have inflows and outflows. Sometimes you have more cash to lend than other times. So the supply of cash after the RP goes to zero becomes a little bit more volatile. And from the demand side, if you are, let's say, in a basis trade, or if you're financing an inventory of securities, you got to get funded, right? So you're borrowing short term overnight, and your liabilities are longer dated. So you got to get financed no matter what. That inelastic demand is what creates the huge spikes, because no matter what, you got to get financed. But also note, though, that these are overnight loans. So even if they spike significantly on an annualized basis, it's not that much money. It becomes a problem if it persists for a few days, but if it's just one day, it's tolerable.
So we had that repo spike to, on an annualized basis, absurd levels in September 2019. We now have the standing repo facility. Why haven't banks jumped in and started to use that standing repo facility? I have the overnight repurchase agreements, now at $2 billion. So $2 billion of the standing repo facility has been tapped. Why isn't it more if these disequilibria in money markets are making themselves apparent?
That's an interesting question. So it is being used a lot more than it has in the past, right? It used to be zero for a long time. Now it could be that banks are just not as comfortable as just borrowing from the Fed. It's possible that there could be some kind of stigma, like borrowing from the discount window. I don't know. But another possibility is that when you're borrowing from the Fed, you're using repo and on a platform called Triparty, and in that platform, it's not nettable. So if you are, for example, if you're borrowing 10 billion and then lending it out to someone else at ten billion to someone else, if it's a nettable, transaction, then on your balance sheet, it doesn't increase its size, right? 10 billion in liabilities, 10 billion in assets,
Oh,
it nets to zero. So that netting is kind of important because a lot of times, if you're part of a bank holding company, the size of your balance sheet incurs regulatory costs. But if you're borrowing repo from the Fed, it's not nettable. And so you're expanding your balance sheet. That incurs regulatory costs, and that has to be taken into account as well. So that's a possibility as well. I'm sure the Fed is encouraging dealers to borrow more, but so far it just hasn't been super effective in providing, um, I guess, something of a soft ceiling for repo rates.
So uh, the spread of 10 to 15 basis points of SOFR over Fed funds over OBFR is not sufficient to induce dealers and banks to and other people to tap the standing repos facility. You're going to have to see uh, a bigger spike.
Looks like that's how it is
Yeah,
so far. So far, yeah.
yeah, I gotcha. Um, All right. Well, let's turn Joseph to the more vanilla, more typical topics of just interest rate cuts. Um, what was your take of the meeting today, and I guess the significance of the Powell's comment that don't take it for granted that we're going to cut in December, because the market was a little greedy coming into it. Nick Timrose asked the first question and said, are you alarmed by the fact that the market has basically taken it, uh, priced in so many cuts?
Yeah, he was being hawkish. So I think what he's really doing is being cautious. So he doesn't want to commit to that December cut because he just doesn't know. He doesn't have any data. He doesn't know what's going on. And I think he looks at financial conditions, sees that they're loosening. I think he looks at those GDP now predictions. It looks like the economy's booming. I think he looks at and looks at the labor market. It's not getting better, but it's not getting worse. Part of it could be just due to reduced labor supply. Last time he thought that, we've had such a decline in the supply of labor that even zero jobs growth a month would be okay, would be at the break even rate. So I think he's looking at all this and saying, I have no idea what's going to happen. I don't like all these cuts priced into the market because, maybe things are not as bad as I think they are. So I think that's what happened there. So really, it's a hard place to be in because you just don't know, you don't have the data to make good decisions.
Right, and we had two dissents, one from Governor Myron, who asked, "No, 25 basis points not enough. We should do 50." And then Schmid, who's a bank president, who's a voting member, he opted to not cut at all.
So he's the Fed president. He's been pretty hawkish.
Yeah.
And I think there's an interesting question. What will happen to the Fed presidents who are supposed to be reappointed in February? So there was a question about that. One of the thinking was that, if you have a more Trump centered board of governors who could veto Fed president appointments, maybe they would just swap all the Fed presidents out with someone who is, or people who are, more pro rate cut. Doesn't look like that's happening so far. But yeah, he wanted to have no change in the policy rate. And Governor Myron, as you mentioned, would like 50 basis point cuts, and I think he's going to do that at each meeting, ask for 50 basis point cuts. And he has some interesting reasons why, right? He gave us a good speech that clearly shows that there's been a lot of changes in fiscal policy in other policies that make it so that maybe the Fed can be a little bit more dovish. In the beginning of the year, Chair Powell was looking at everything that was happening with policy, with tariffs, with immigration, with regulation, all forth. And Chair Powell was like, just shrugged his shoulders and said that I don't know what's going to happen, so I'm just going to do nothing. Basically, commit to being late. Governor Myron and Governor Bowman is actually thinking that, that's not a good idea. I think we should be more forward looking. And one of the things that Governor Myron has been saying is that since we have less immigration, that means less demand for shelter. That's going to put downward pressure on rents. That's disinflationary, right? And that's been playing out over the past few months and at the recent CPI report as well. So if you take into account some of these policy changes, you could make an argument that rates should be lower. But again, it's very, very difficult to know how all these policies will play out, especially since they're changing all the time. Like the president is in Asia making all sorts of trade deals, encouraging more investment and so forth. Looks like he's going to have a summit with President Xi, and looks like tariffs on China will come down. So it is hard to make forward-looking prognostics. But on the immigration side, though, over the past few months, that's been very clear, and it is also going to obviously have downward pressure on rent.
Right, and so you said President Trump looks like he's going to meet with President Xi, lower tariffs on China. He said that he expects to lower the fentanyl tariff from potentially from 20% to 10%. There's so much uncertainty because only a few weeks ago, earlier in October, President Trump posted on Truth Social that President China is not being very nice and that he's going to spike them to a huge level. So it's very, very hard to interpret the future here. Governor Myron ably has made the argument that the cocktail of lower immigration, tariffs, etc., is going to lead inflation to be lower. Therefore, interest rates should be lower. So he's a dovish dissenter. And then, of course, there is the argument that tariffs and the Trump policy, the one big beautiful bill, is going to be inflationary. Where do you fall on that spectrum of the current Trump administration's policies? Are they inflationary and therefore the Fed should be hawkish? Or are they disinflationary and therefore the Fed should be dovish?
They're both inflationary and disinflationary. I don't know how super complicated, right? You put tariffs on, obviously that's going to have some impact on prices. So far, not a lot. You decrease the growth of population, that's going to have some impact. It's going to put upward pressure on wages, which I think is part of the reason why the president got elected. But it's also going to put down pressure on things like shelter, because housing is, it's less not elastic, right? So you can't suddenly build a whole bunch of housing. So once you have less population growth, rents will come down. And looking at his uh, other, let's say, expensing, for example, OBBA does a lot of encouragement for people to build in America. Well, that short term, you're going to have more demand and real resources. That's going to put prices up. But if you do increase factories and so forth in the United States, that increases supply going forward. So that's disinflationary. So there's a whole lot of moving parts. It's not easy to say. And of course, the president is doing something very interesting with international trade. He's basically confiscating the foreign reserves of allied countries and forcing them to take that money and build factories in the United States instead of buying treasuries. So, maybe that will also have a increase in supply in the coming years. So, I think the big picture is that they are trying to increase supply and get inflation lower. But in the short term, though, uh, we might not see that impact.
Thank you, Joseph. How are you thinking about the stock market right now?
Obviously, we're in a huge bubble, right?
Yeah, for
But
real.
yeah, obviously,
Okay.
things only go up. Everything goes up. So when I look at the stock market, it kind of reminds me as to how gold traded the past few weeks, right? You go into a period where you just go straight up, straight up, straight up. It looks like you're going parabolic, and then suddenly you decline. So I feel like when I look at the markets, we're entering this phase with it seems like stocks only go up. I've noticed that when we have bad data, oh, that means rate cuts, market go up. If we have good data, that means the economy is good, market go up. And there's a lot of people pouring in here just chasing momentum. They have a lot of different narratives, but at the end of the day, people are just buying because the market goes up, and it's been working very well. And I think feel like when you're in this phase in the market, it's hard to say how high you can go. Maybe you really just follow the dot-com blueprint and go higher than anyone imagined. But at the end of the day, though, it's most likely followed by a sharp decline. And that worries me a little bit because so much of the economy is dependent upon the wealth effect. If we do actually go have some kind of blow off top and afterwards we have a decline, that almost guarantees us to be in a recession. And not just that, I think there's so many people who are basically just spending their day just buying stuff in the market, right? I go to a cafe, I see this nice old man sit down, open his laptop. I think he's looking at photos of his grandkids, but actually he's drawing candles and trying to figure out, well, when to buy and when to sell. So it's really very much a speculation nation here. And usually speaking, most of these guys, they lose money. And I think that's going to upset a lot of people. So uh, I understand the president likes the stock market higher, likes to claim credit when it goes higher. It's definitely making people like him. But if you take credit on the way up, you will get blamed on the way down. So that may not be super wise.
And Joseph, you noted for being a giant bull on the equity market throughout 2023 and 2024, primarily for reasons of just very, very strong earnings growth and GDP growth, consumption, as well as declining inflation, all of which has been proven right. How much of it do you think is just the earnings growth is really NVIDIA as well as other companies that benefit from AI capital expenditure? Most of that money being spent by extremely large companies, Meta, Amazon, Google, Microsoft. The list goes on. OpenAI, which is not publicly traded, but may IPO in 2027. Who knows? And with the exception of OpenAI, these are very, very profitable companies. And so just the profits and the profit expectations for NVIDIA just keeps on going up. NVIDIA is now a $5 trillion company. And, Joseph, you could be right. The other bears, could be right. Obviously, not having been a bear throughout all this, but, recently, I guess it sounds like you're a little more bearish on the economy, on tariffs, but it's just, that doesn't matter. You're right on the wrong issues, and AI capex just continues to the moon until it eventually goes down and implodes. But there's you can call a bubble and be right 3 years later, but that's not the same as being right. To
Well,
call.
first off, I want to be totally clear that I have not been on the equity market this year. My call on the equity market, I've been bear most of the year, worked really well until the president posted that we should buy stocks, and then it did not work out well. So no, so I've not been doing well, not have a good call on the equity market this year. So keep that in mind as I say this. Now, the companies have been spending a lot on capex, and the market has perceived that as positive. But at the end of the day, you have all these companies that are generating a lot of cash. They used to give it back to their shareholders through buybacks. Now they just basically burn it on investments that may or may not pay off. And a lot of reports suggest that the AI stuff, super cool, doesn't seem really to be making money so far, and doesn't seem to have a clear path to do so. So I think that kind of speaks to the market sentiment. Whereas I feel like if the market could easily perceive these investments as being a waste of money and penalize the companies for it, today they're perceived as everything is great. You have all these daisy chains of investments and so forth. So I think it's really just sentiment and momentum. I wouldn't really read anything more into it. Everyone has a good narrative as to why they buy something, but at the end of the day, it goes up, you feel good, and you buy more.
And how are you thinking about foreign ownership of equities as well as the valuation of the dollar? This, view and theory that tariffs would spark a sell-off in U.S. assets, both treasuries as well as stocks. The rest of the world owns a lot of U.S. assets, as you know. That theory hasn't really played out. Yes, you've seen an increased hedging amount, but in terms of the Iceland, Norway selling Nvidia, they really haven't. They've been buying more Nvidia, and they've been doing dollar swaps and hedging off that currency risk. But have they been selling Nvidia? No.
No, no. They sold, I think, in 1 month or 2 months, and then they came back in size. They just can't get enough of that stuff. I was speaking with some of our investors, and they felt that U.S. tech is the place to be, and you can see that in the $5 trillion market cap of Nvidia. Now that kind of surprises me, really. So we have this administration that's doing a lot of things that if you were a foreigner, I feel like you would be a little bit more cautious, but apparently not. Apparently, number go up. What I do think this means to me, though, is that when the downturn does come, I think it would be very nonlinear. So you kind of have this built-in dollar exposure built into the market that is, I think, very very large, and could potentially mean the downside could be larger than it would usually be, because let's say that we do have a recession, and so we have a tumble of the market. Okay, then that would mean the Fed will cut rates rapidly, and that would mean the dollar would depreciate, maybe a lot. That's a recipe for disaster for a foreign investor, because you're losing as the stock price goes down, and you'll lose as the dollar depreciates as well. So you definitely need to get out, and because there's such large foreign exposure to the US equity markets, that decline could be significant. So I think this is one of the mechanisms going forward that if we do have a blow up top that actually leads to a sharp decline, could accelerate that to be something that's quite deep. So it's just another mechanism in the market that I think we should be aware of.
Well, Joseph, I guess let's just talk about this issue of Federal Reserve independence. If President Trump is appointing people who are going to be calling for interest rate reductions, which the president wants, that would be a Federal Reserve that is no longer independent. That is a strong influence by the executive branch, by government. And President Trump himself has said, I think I should have a say about interest rates. That's kind of declaring that he doesn't believe in central bank independence. That's my interpretation. A lot of people number one, do you think that that is a departure from central bank independence? Number two, do you think that that is a bad thing, which I'd say a lot of economists think is a bad thing?
So obviously, the president would like to set interest rates. What president doesn't, right? So I'll say this about central bank independence. Now, I think central bank independence can be a really good thing because we are in a political process where the executive would always like to have lower interest rates to temporarily boost the economy, and we've seen that happen with Nixon, for example, trying to get lower interest rates, boost his chances in the election, and then afterwards, maybe we have inflation, but hey, I'm not up for reelection anymore. So I think that's the fear there. But that tells you one thing very clearly, in that a central bank is never really independent. It's always operates under the elected government. So we've had an independent central bank in the US since the 1950s. And yet we did have that episode happen with Nixon, and we have this episode happening right now. So the central bank is composed of people, and they always operate under political constraints. So that's one thing. But more broadly speaking, though, if you look across the world, so let's say that you have central bank independence in the UK and France, they didn't get that until the 1990s. And it wasn't because they had a whole bunch of inflation and finally the legislators said, we can't take this anymore. We got to give our central bank independence. It was they were having low inflation leading up to the independence, and they just decided to change the system, probably just to get in line with what other people are doing. So even without central bank independence, you can still have low inflation, and you can even look across the world to China, which has a very complicated managed economy. They don't have central bank independence, and they still have low inflation. So you can have a central bank independence and still get inflation, and you could not have an independent central bank and have low inflation. So it's not necessary and it's not sufficient. Now, this is, but the last point that I'm going to make is I think it's more important, and that the central banks today are very different from the central banks in the past. Today, the Fed is super, super powerful, much more powerful than the central bank has ever been. You only have interest rate policy, you have balance sheet policy where you can go and buy, trillions of mortgage-backed securities, get mortgage rates super low, make a whole generation of people locked out of the housing market today. And of course, you also have regulatory power over banks, whereas you can control who gets access to credit. Maybe in some countries they could do this, make sure that loans are given to green endeavors, for example. So a central bank today is super, super powerful.
Although the Federal Reserve has abandoned that, I should note, right?
Yes, but I'm just talking about the Fed as an example. So the ECB also super powerful as well. Central banks in general today are much more powerful than they are in the past. And when you look at the political issues today as a society, one of the most pressing ones is like home ownership, right? A whole bunch of people can't afford homes because a whole bunch of people, home prices have gone up in part because mortgage rates are low. And of course, it's wealth inequality. People who own financial assets, well, they're doing pretty well. We have this K shaped economy. So, some of the most important distributional things in our society are basically determined by a, a small group of people sitting at the central bank. So if you believe that we should have a democratic society, it seems to me that it makes sense for the public to have some say in matters that have huge distributional impacts on the society. So you can make the argument that because central banks today are much more powerful than the past, they have to be less independent. Or you could pare them down, maybe separate regulatory power out, maybe make them single mandate, inflation only, and so forth. So, uh, yeah, I think you can make a good argument that uh, central bank is too powerful to not have any kind of democratic say. Simply, So I think that's an argument you can make, and so it's not super unreasonable from my perspective for you to say that uh, maybe the Fed shouldn't be independent. And I understand that it's a policy decision, right? There are pluses and minuses. It's not just, oh my God, we have independent central bank. These guys would be so wise and smart, and everything would be okay. That's just not how the world works.
Joseph, this near consensus among economists that central bank independence is good and necessary to have stable prices and not have runaway inflation have you always disagreed with that, or has that been a process? And if so, tell us about that process.
So what you read in textbooks is what you're saying, Jack. And one of the things that I have come to realize in my life is that uh, a lot of the things you read in textbooks sound reasonable, but are not actually true. And they're basically the work of very high IQ people, but who don't have a lot of direct experience. So that sounds totally reasonable, but it's just not true. And we've talked about many examples why that's just not true. One thing I'll note is that inflation is unpopular. So you have other checks on inflation, and that's a democratic process. One of the reasons why President Biden was not successful, okay, Vice President Harris was not successful in the last election was because inflation was too high. So boom, you mismanaged the economy, inflation was too high, you got kicked out of office. That works, right? And it works in Argentina as well. Inflation too high, you have this guy with a chainsaw going on and cutting things. So you have this democratic accountability there as well. So that's another thing to keep in mind. It's just not about the central bank. And one other thing is that inflation is a complicated thing. So at the high level, it's when demand pushes against supply, but it's not. Demand and supply are not all about interest rates, right? We've seen over the past few years that interest rates went up to, multi-decade highs, but because of all the fiscal spending, it just didn't work. And because of COVID and things like that, supply chain stuff, inflation was high. So it's not all about interest rates. So it doesn't really make sense to give inflation just to one organization who does not have the tools to carry it out. Now, a lot of the research that people cite in saying that central banks have better outcomes for inflation, blah, 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 a lot of that was done during the Great Moderation when we had China entering into the global stage. Now, the central banks were doing their thing and inflation came down to 2%, and they kind of patted themselves on the back, being like, my gosh, I convinced everyone inflation expectations stable and got inflation down. It's all me. So you got to give central bank independence. But on the other hand, you had literally several 100 million people enter the global labor force with China entering WTO. And I'd say that had a pretty big impact on inflation as well. So you have all these things that determine inflation that are definitely far more than interest rates. So to think that you could have some kind of entity that set interest rates and inflation to be under control, I don't think that's how the world works.
For the sake of argument, I'll just push back a little bit, which is that you were correct when you said, or you basically implied, that this whole central bank independence thing is a very new thing in 1980s, and other countries 1990s. And I'll say you're correct, but I'll say the era where we had runaway inflation, where we didn't have central bank independence, was the 1970s. And that whole, Richard Nixon just let interest rates go up, he asked interest rates to not go up too much. Isn't it a lesson from the 1970s that ran amok? And I would also make the argument that pre 1971, the U.S. was on the gold standard, and the rest of the world was also constrained to a lesser degree because they were on the dollar standard, the Bretton Woods system. And then, of course, we were on the gold standard in the 1920s, and then going back, there's been various metallic standards that were constraining the amount of, basically, the print this let the central banks have interest rates wherever they want, and let the government set interest rates. That is often been accompanied by monetary instability. So just what do you make about that argument?
You're right. There's a different regime back then, and it's difficult because of all the differences in the system. But you don't have to go back that far. You could just go back, let's say, 4 years. We have independent central banks across the Western world, inflation to the moon. Or you can go back to today. Inflation's at 3% and has been for some time.
Mm-hmm.
We have independent central banks, right? So, it's not all about that. Um, you have a lot of other factors that have to that matter as well.
That's true. What if Joe Biden during 2022 was tweeting and saying that Jay Powell is out of control, raising interest rates from 50 basis points to 125 basis points? Maybe I'm thinking about firing him. Would that have been a good thing? Clearly, the Federal Reserve raising interest rates in 2022 was, not just good and necessary, but like probably overdue. Would you have, supported President Biden just stopping Fed rate cuts, or as well.
In 2022, it seems like inflation was pretty high. So I think that was the right thing to do. And I
Yeah.
think they did have political support to do that at that time. Um, but again, inflation is not all about rates. And also, the central bank always operates within the political constraints. And at the end of the day, when inflation was out of control, the elected government lost and we got replaced. So there was democratic accountability as well. So it worked. Um, um, so I wouldn't be too worried about the Fed losing independence. It probably will. It looks like we're in that kind of political era, but it doesn't mean that we'll go into hyperinflation, right? A lot of people point out that, oh my God, we end up like Ergodan. That's an extreme example. I remember we've countries have been under politically controlled central banks for a long time, and things were okay. So that's not the only outcome. I think that's very obvious fear mongering.
Yeah, I mean, hyperinflation means 50% inflation or 50,000% inflation. I just think that in the United States that is very unlikely. Just to put my views on there. So Joseph, the price of gold has been rallying like crazy despite the recent pullback over the past, let's say, 10 days. A lot of people attribute the surge in gold to fears of central bank independence, and basically the Federal Reserve is cutting rates. How are you thinking about precious metals? Yeah, what's your outlook on it and its potential relationship with the Fed?
It's just momentum, like everything else. So there's a popular thing, like you got the debasement, right? So what does that mean for fiat currency? Debasement means your money is worth less than it was before. That's inflation, right? So debasement, 100% happening. Got a $2 trillion deficit. Got inflation was 2%, now it's 3%. So your money, fiat money, being debased, no doubt about it. Does that mean gold has to go to the moon? 10,000, 100,000? That's up to you to decide. So, the debasement trade and all these things, I think of it as just momentum, like everything else, like we see in Bitcoin, like we see in AI stocks, like see in uranium stocks and so forth. A bunch of people just buying something that works, making a lot of money, and then when it collapses, moving on to the next thing. So, I wouldn't read too much in these macro narratives. I think we just have a class of investors who understand now that basically everything is like an NFT. You buy it, it goes up. You squeeze it, it goes up, and then you try to go to the next thing.
Right, and gold has no real intrinsic value in terms of trying to value it. So there's no reason for it can't go to 10,000. No reason it can't go to 2,000 or lower, as opposed to stocks that
Well, let's be
theoretically have
clear
a
now.
valuation anchor. What do you say?
We said Palantir is trading at like 600 PE, so I'm not
Yeah.
sure. I'm not sure that really matters either.
Yeah,
So,
yeah, fair point. Joseph, closing thought for you is, in preparing for this interview, I read your most recent pieces on FedGuide.com. They are just so good. I mean, you're such a good writer, obviously you're such a smart thinker and good writer, but in particular, there's no fluff in your pieces, and it's amazing. Like, I guess only like some like novels and literary authors who are famous for this quality is where I see such an economy of words. So I just want to give you a shout out there. Your most recent, your penultimate piece, on Wells Fargo was interesting. Just share your views on the overall commercial banking sector, as well as this thing that you talked about with swap spreads. So not SOFR, but interest rate swaps have been negative. So basically, swaps are a lower interest rate than treasuries, but they have been getting less negative. And you attributed this to Fargo's asset cap being lifted. Explain just your thoughts on this issue, as well as just your overall outlook of commercial bankings in this context. Which have most of the big ones have reported earnings so far.
so based on the recent earnings of the big commercial banks and the big regional ones as well, the U.S. economy is doing fine. I mean, if J.P. Morgan asked about the state of the U.S. consumer, flat out and said the U.S. consumer is fine. So everything seems to be okay. And these big banks, they have a lot of information about the economy because everyone has accounts there. They see your credit card spending and so forth. So they have the absolute best data, and they think the consumer is fine. And with regard to credit concerns, we see that reported in the market as well. If you look at the loan loss reserves, the banks hold, delinquencies, they're all fine as well. Excuse me.
Yeah.
They've actually improved over the quarter sequentially. So, from their perspective, the U.S. economy is good, and I think that's the key takeaway from bank earnings reports. Now, with respect to the other stuff, Wells Fargo had an asset cap on them. Wells Fargo is one of the largest banks in the US. Also, they have a sophisticated markets practice. So when you have an asset cap on you, you kind of limits your ability to do new businesses. Once that cap was removed, they actually grew their markets business by about $100 billion. And 50 billion of that seems to be increasing lending and repo. 50 billion seems to be in higher inventory of securities. Now, what that means is that you kind of have the pipes in the financial system are wider, and so that helps get cash to where it is. That narrows spreads, and you can see that I think a little bit in how quickly the RP was emptied. So now you can have money market funds, instead of lending to the RP, they lend to Wells Fargo, who then lends to someone else. So pipes are wider, and the swap spreads are also less negative. There's a lot of things driving that, but one of the things I think contributed to that is that there is more balance sheet capacity available throughout the broader financial system because Wells Fargo, one of the largest banks in the U.S., had its asset cap removed. So that was a smart thing. The Federal Reserve and other regulators did, and I think we're going to see more of that as they try to deregulate the banking, reduce regulations on banking sector, reduce capital requirements. So that is a bullish thing for the U.S. economy, but it's going to play out slowly and gradually.
Joseph, you got this phenomenal chart on an issue I've actually been pleased to cover a lot on Monetary Matters: the commercial bank loans to non-bank financial institutions. A huge amount of loans, commercial and industrial loans that banks were making, actually disappeared overnight because they were reclassified as loans to non-banks. So the old model of a bank lends to a company or an industrial facility, a factory, that's kind of out the window. Now the bank is lending to a private credit company or a business development company, and then those companies make the loan. So the banks, you could say, is de-risked, so it has a more senior position. But increasingly banks are not really lending to the economy. And I was actually at a conference, so this data is recent, that like 9 to 10% of bank loans are to non-bank financial institutions or non-depository financial institutions. What do you think is the significance of this, and do you think it makes in any way the Federal Reserve's jobs harder?
No, it makes the Federal Reserve's jobs much easier because it de-risks the banking sector. In the past, if you were a bank, you would lend to a company, and you'd have some risk there. Now, what you do is you're a bank, you lend to a private credit fund or some kind of private investor. They're usually teams of people from very highly regarded companies. So, your big asset managers like a BlackRock or something like that. And then those guys then take the money and they lend to other companies. So let's say that the company has a default. What happens? Well, the private credit lender deals with it. And when the private credit fund has exhausted their resources, then it becomes the bank's problem. So the bank has this extra layer between them and the ultimate borrower that insulates them from credit risk. And that's the reason why they do it, because it's from a because there's less risk, it's cheaper. There's less. It costs the bank less capital to make that loan to the NBFI than it is to the ultimate borrower. So we have this shadow banking sector that gets its financing from the commercial banking sector and then lends it to the real economy. So it makes the Fed's job more difficult in that it doesn't really know where the money goes, but it makes the banking system safer. And I think that's really what the Fed cares about. Because when the banking system fails, that affects everyone. When you have some private credit fund in the shadows that fails, that they're not tradable, so they don't really cause panic in the market. And also, no one has deposits there. I mean, they borrow from wealthy individuals and so forth, but it's not like a systemic event that impacts the broader public.
Yeah, when you describe it, it sounds like nothing can go wrong, and I understand the argument. But often, Joseph, as you know, what causes financial crises are not risky things. It's things that seem very safe, like mortgages. All the analysis going to subprime mortgages was correct. That like during a recession, housing prices never go down, and everyone pays off their loans. And but that then you had an obvious credit bubble. So it kind of seems like everything you said is correct, but because it's so safe and so great, it's going to keep on happening and happening until it gets to wretched excesses. To use a Charlie Munger-ism.
Well, it's not safe. It's just that the risk is borne by people that is not. It's not borne by the public. Like if it was borne by the commercial banks, at the end of the day, the government has to go bail them out because banks are too big to fail. But your private credit funds, your big financial sponsors, those guys, they're not too big to fail. They can go bust. And so I think it's just placing risk away from the public, and maybe that would align incentives a little bit. Because let's say that you are a big GSIB, you can do whatever, government will bail you out. So that's a bad incentive. But if you move that risk to uh, the private financial companies, they won't get bailed out. At least I don't think. Maybe the Trump administration is different. Maybe that uh, makes their incentives more aligned with with just being more prudent with their risk. So right now, it does seem like there are people worried about what's happening in the private credit space. If you look at the publicly traded private credit funds, they're called BDCs. They've been taking a big haircut on their price. So it does seem like there's some concern over there. But again, if a private fund goes bust, it's not systemic. It's mostly money from wealthy institutions and rich people, and they can bear the losses.
Yes, actually some of those BDCs, I think the sell off might be overblown. What do I know? But in particular, it's these non publicly traded BDCs like private credit funds that I don't want to say I have concerns over. I just have questions over them. Like, some of these yields I've seen, actually, this is in BDCs, are 15%, 14, 16%. Like, if you don't get that money risk free. And I think these are kind of being marketed to investors, a broader swath of investors who are maybe less sophisticated. Yale and Harvard used to be allocating to them. Now they may be tapped out. Now they're going to wealth managers and all the types of people. And maybe it is going to be impacting people. Also, Joseph, a selling point of these things were that they're unlevered, or it used to be we use almost no leverage. The BDCs are levered, but the private credit funds were not levered anymore. Now they are being levered, like banks are lending to private credit funds. So the leverage is increasing. The equity is coming less from institutional investors, more from retail or retail-ish people investors. It is becoming more levered. I think the cycle is aging. Again, I don't want to say portray just a doom and gloom narrative, but just want to give the full perspective.
Yep, good perspective.
Yeah. All right, Joseph, can you just give us just a brief overview of where do you think the what are you going to be tracking for the Federal Reserve over the coming weeks and months?
I think the trend this year is less about the Fed, more about what happens with the White House and the AI companies. So, unfortunately, as a Fed watcher, it's just not that important. But if you were to focus on the Fed, it would be about the ultimate composition of the Fed's balance sheet, whether or not they really will significantly shorten their duration, and how quickly will they get there? Will they actually sell securities to get to their final composition? That's what I would be looking for in the next few months.
Oh, that makes sense. And just a final question: how tightly correlated are the level of bank reserves, but in particular the minute stresses of a few basis points here, a few basis points there, in terms of SOFR spreads going up, in terms of swap spreads going up, whatever? How correlated is that with true financial stress of credit spreads going up and the stock market going down? Like,
I don't believe it's correlated at all. It's just a
not correlated.
tiny, tiny. It's a huge market, very important, but also very obscure. Uh, so I don't really think it. I mean, if you look at what happened in September 2019, it didn't really affect the broader market at all. So it's just kind of too niche, too in the weeds. But at the end of the day, it's essential from the Fed's perspective, and so the Fed will also always step in and build that market out. So I don't think it's anything to worry about.
All right, Joseph. Well, we'll leave it there. People can find you on FedGuy12. Your excellent writing is at fedguy.com. And I'll also say, Joseph, that next week, so very early November, I will be interviewing a very high profile guest. And by very high profile, I mean very, very important. So a true VIP, definitely the most powerful and influential person who I've ever interviewed on my show, Monetary Matters, and my previous show, for Guidance, in my entire career. And so people should stay tuned to Monetary Matters in early November. They will want to be paying attention. This is not one you want to miss.
And I know who it is. And Jack, he's not overselling it. It is someone you don't want to miss.
Thank you, Joseph. This will obviously air on Monetary Matters, Apple Podcasts, Spotify, and YouTube. Subscribe to all that. Leave a rating and review. On Spotify, we now have video, so we'll put up a few of Joseph's charts from fedguy.com, so Spotify listeners can now see that as well. And we'll also be sharing this with Joseph, so this will go live on Joseph Wang's YouTube channel, where he
Yes.
has his weekly updates, which are very, very valuable and good as well. Thank you, everyone, for listening, and thanks again, Joseph.
Thanks, Jack.